This is not financial advice. I'm recording my thoughts about Etsy stock. Etsy stock is currently trading at about $82 and it's down about 28% year to date. And from its all-time high of $294, it's down about 70%. So is it the time to buy the dip to get a good return or not? In this video, I'm going to go over Etsy's business model briefly. Then I'll go over its financials and finally I'll do a valuation to confirm whether this is a good entry point or not. Let's first look at Etsy's business model. Etsy is the global marketplace for unique and creative goods, mostly the handmade goods. And when you say Etsy, you always get reminded of the decorative items, which are discretionary purchases. And Etsy's mission is to keep commerce human. And that explains the reason behind them being a marketplace for unique and creative goods. Etsy does have some sub-businesses. The primary marketplace is Etsy.com, which connects the artisans and entrepreneurs with their consumers. And they have Reverb, which is a musical instrument marketplace. Then there is Depop, a fashion resale marketplace. And they have Elo7, which is a Brazilian-based marketplace for handmade and unique items. So we do know that Etsy has different sub-businesses that get more revenue. And at the same time, they spent a lot of money acquiring these different sub-businesses. And we will see what it did to its balance sheet when I go over the financials. In summary, we can think of Etsy as an e-commerce platform. Now let's move on to the financials. At $82 stock price, the market cap is about $10 billion. For the past 12 months, they made a revenue of about $2.63 billion. That puts the price to sales at about 4, which is decent. For the past 12 months, their net income was negative $700 million, which is not so good news. But in the most recent quarter, they did make some profit. But the point here is that there's no PE ratio so far. Forward PE is 33.44, which is very expensive for the kind of growth and margin this company has. And we will go over those financials shortly. In the most recent quarter, they made about $641 million of revenue, which represents 11% year-on-year growth. But then the stock has fallen down significantly, and that's because of the guidance for next quarter. In the next quarter, they're saying they can only make about $590 million to about $640 million of revenue. But a year before, in Q2 of 2022, they made about $585 million of revenue. So if you think about it, if they make $590 million in the next quarter, that's flat growth, pretty much no growth. Even if they make the $640 million, the upper end of the guidance, that is still 10% growth rate, which is not too impressive. This lower than expected guidance upset the shareholders and the stock sold off. Currently it's at $82. Let's look at their income statement to get an idea of their profit margins. In the most recent quarter, as I said before, they made about $640 million of revenue and the gross profit is about 70%. That is very impressive for an e-commerce platform. And they're spending about $171 million in marketing expense. And since this is e-commerce business, the marketing spend will be higher. There is no way out of this. And the net income, as you see on the screen, is about $74 million. For a revenue of $640 million, the net income is $74 million. So that's about 10% or 11% net profit margin, which is not so bad for e-commerce business like this. Etsy is showing the adjusted EBITDA figure, which I personally do not take seriously, but how they ended up with 170 million adjusted EBITDA, that's because they're adding the stock-based compensation and depreciation amortization, both of which add up to $90 million. And that is getting added to the $74 million of net profit. And that's how they are ending up at $170 million of adjusted EBITDA. But we have to focus on the net income, which is a better representation of their profitability. So 11% net profit margins, remember that. Let's have a quick look at the balance sheet. They have close to $1 billion of cash equivalents, and short-term investments. Before you get excited about this $1 billion of cash reserves, look at the total assets. They're about $2.5 billion and the total liabilities are about $3 billion. So the book value for this company is negative $540 million, which is terrible. So how did this happen? How come their liabilities are so high? And that is because of the costly acquisitions they made during the pandemic. And as we all know, during the pandemic, companies were paying price to sales of 10 or 15, which are ridiculous, to buy other companies which are not profitable. And that definitely hit Etsy, and that's why the book value is negative, and this is a huge red flag. Just to give you an example, Etsy paid $1.6 billion in cash to acquire Depop, which was a used clothing online store. At the time of this acquisition, the stock price was very high. They could have used stock to pay for this deal, and that would have made a lot of sense. Yet, they used cash to buy this company. So that's a huge red flag in my opinion about management's ability to use the cash that they have. Now let's look at the number of outstanding shares to see what's happening there. As you can see on the screen, they are buying back shares. The basic weighted average common shares outstanding are about 127 million a year ago, and after Q1 of 2023 they were about 124 million. So that's about a reduction of 3 million shares, which probably they have bought back. And on a fully diluted basis, they have about 140 million outstanding shares. So just to give you a perspective, you can see on the screen, the weighted average common shares outstanding basic are about 124 million, right? On top of that, we have to add about 18 million extra shares, which are caused by the conversion of options to purchase common stock, and there are restricted stock units typically offered to their employees, and then there are convertible senior notes causing about 14 million outstanding share dilution. So that is an instrument to raise cash, kind of like debt. Etsy also is buying back some of the stock. As I said before, they spent about $148 million to purchase about 1.2 million shares. On March 1st, they have 2018 convertible notes. They got settled for 1.19 million outstanding shares. So they are settling these convertible notes, in other words, paying back the debt to reduce the dilutive effect of the shares. So overall, this is good news that they are buying back shares, but we have to focus on what the underlying business is doing. In conclusion, with respect to financials, their growth rate is slowing down significantly. Like I said before, in the most recent quarter, the growth rate is pretty much flat. Their balance sheet is terrible. They do have close to $1 billion of cash, but the book value is in the negative territory, which is terrible for a company of this size. And they do have a stock repurchase program. They are buying back shares, but not at the pace that we want, because they barely bought back about 2 million shares when the float is about 123 million. So that's not too significant if you ask me. So let's look at its valuation. As usual, I'm going to provide two cases, one with reasonable assumptions and the other one with great execution. In the reasonable assumptions case, in 2022, we know that they made about $2.56 billion of revenue. With respect to growth rate, I'm only assuming 10% growth rate year on year, because for the past 7 quarters, the average growth rate is less than 10% on an average. So I cannot assume more than 10% growth rate, because Etsy sells consumer discretionary goods. During the pandemic, people had extra cash, they have nowhere to go, so they spent money on home decorations, etc., which are discretionary items. But now that the pandemic is officially over, people are traveling and reducing this discretionary spending. So I don't see any reason why I can see Etsy re-accelerating its revenue growth, so that's why I assumed 10%. With that, they will make about $4.12 billion of revenue in 2027. In the most recent quarter, they got profitable and they have shown 11% net profit margins on a 70% gross margin. And based on the business, it's an e-commerce business, getting to double-digit net profit margin is very hard. But still, I'm assuming 12% net profit margin for this company. With that, they can make about $500 million of net income in 2027. For a company that's growing in the 10% rate and has a 12% net profit margin, I can assume a multiple of 11. But since Etsy has brand value, I can pay a premium multiple of 20, which I think is rich. With that, the market cap in 2027 would be about $9.89 billion. With respect to the number of outstanding shares, currently they have about 123 million outstanding shares. And the company has close to $1 billion of cash, which is enough to buy 10% of the outstanding shares back. And they're also profitable and generating close to $70 million of net income. So I'm assuming a 2% buyback. Don't think that 2% is less because their market cap is $10 billion. So 2% would be $200 million. So 2% buyback for the next 5 years, year over year, is going to result in 111 million outstanding shares for this company. When I divide the $9.89 billion of market cap with 111 million outstanding shares, I get a stock price of $89 in 2027. Currently they are at $82, right? So that's about 9% gain in 5 years, which is a terrible gain. And on top of that, I have a really, really bad balance sheet with negative book value. So my decision is already made. I'm not going to touch Etsy stock with a 10-foot pole. But let me now show you the great execution case, even though I made my decision. In this, I am estimating a growth rate of 15%. If you look into their growth rate for the past 6 or 7 quarters, they are nowhere near 15%. But I'm assuming that people are going to spend more on decorative items and handmade goods and somehow accelerate Etsy's revenue growth rate. With that, they can make about $5.15 billion of revenue in 2027. I'm giving it a net profit margin of 15%, which is extremely hard to do for an e-commerce business. But this is great execution case. So I'm willing to give 15% net profit margin. Based on that, the net income in 2027 would be about $770 million. I'm keeping the multiple same, 20, which is still rich for the 15% growth rate and 15% net profit margin. With that, the market cap in 2027 would be about $15.45 billion. For the great execution case, I'm assuming 3% buyback. 3% buyback means that they will spend $300 million a year buying back shares, which I think is optimistic. With that, they will have 106 million outstanding shares left. Remember that I'm not even considering the dilutive effect caused by the restricted stock units and the convertible notes, which I have shown before. So this is still very optimistic. I want you to understand that. With that, the stock price in 2027 would be about $146. This figure came out when I divide the $15.45 billion of market cap with 106 million outstanding shares. Currently they are at $82, right? So that's about 78% gain in 5 years, which is good, but they have a terrible balance sheet that comes with this great execution case. So overall, when I make my investing decision for my personal journey, I go off of the case with reasonable assumptions. I'm seeing 9% gain in 5 years with a terrible balance sheet. So it's a very, very easy decision to make. I'm going to stay far, far away from Etsy stock. Let me know your thoughts in the comments. Thank you so much for watching.